The modern financial industry projects an image of relentless, high-stress action. We are taught that wealth is built on the frantic trading floor, staring at multiple monitors, executing constant trades, and reacting to breaking news by the second. In almost every other profession, putting in more hours and outworking the competition yields better results. In the stock market, that instinct actively damages your portfolio. This chart tracks actively managed large-cap funds over a 20-year period. Over 2 decades, more than 90% of highly paid active fund managers fail to beat their simple benchmark index. Every trade incurs a cost. High expense ratios, management fees, and constant turnover act as a hidden, persistent tax that drains the principal before it even has a chance to compound. The financial industry relies on this turn. They sell complex, high-stress trading strategies because management fees generate billions of dollars for the institutions, regardless of whether the retail investor actually makes a profit. Vanguard founder John Bogle championed an opposing philosophy. He called it the majesty of simplicity, a method of capturing global economic growth without ever attempting to pick a winning stock. This alternative strategy requires making just 3 basic decisions to set up your allocation, and then entirely refusing to participate in the day-to-day noise of the market. To build multi-million-dollar wealth, you do not need to outsmart the market. You simply need to own it entirely. Building this system starts before a single dollar reaches an investment account. By implementing a rule to pay yourself first, you bypass the temptation to spend by automating deposits the exact moment a paycheck clears. Personal finance author Dave Ramsey outlines a strict baseline. Automatically deduct exactly 15% of your gross household income before paying any other bills. This graph illustrates the math behind that habit. If a household automates 15%, about $750 a month, and earns an 11% return over 30 years, the final balance eclipses $2.4 million. Willpower is finite. Strict automation removes human behavior from the equation, turning wealth creation into a steady mathematical inevitability. Once that 15% is in motion, it needs a precise destination. This is asset location, routing your capital into specific tax-advantaged containers. The absolute first priority is directing funds into an employer-sponsored 401k, exactly up to the limit of the company match. An employer match guarantees an instant 100% return on your contribution. It is literal free money, and capturing it is the most efficient financial move an investor can make. After securing the full match, the remainder of the 15% is routed into a Roth IRA. In this account, the capital grows and is eventually withdrawn completely tax-free. A 401k or a Roth IRA will not grow your money on its own. They are protective architectural buckets, engineered specifically to shield your capital from government taxes while it sits inside. Inside those protective tax buckets, you place the engine. The 3-fund portfolio uses just 3 index funds to purchase a microscopic slice of over 10,000 individual securities across the globe. The total U.S. stock index fund is the core engine, holding every publicly traded American company. The total international stock index fund provides diversification across global markets. The final layer, the total bond market index fund, acts as a shock absorber against severe volatility. Because these funds blindly track market indexes, expense ratios drop as low as 0.03%. There is no highly paid active manager, completely eliminating the risk of a person making a bad call with your money. This graphic shows a target date fund, which automates the process even further. It packages those exact same 3 indexes into a single product that gradually shifts its internal balance from aggressive stocks to conservative bonds as you age. Whether you manage 3 funds manually or hold a single target date fund, the result is identical. You have purchased the entire global economy at the lowest possible cost. The architecture is complete. Capital flows from your paycheck into tax-advantaged buckets and across the global market without a single manual keystroke. The only remaining vulnerability is human emotion. Under severe market pressure, the impulse to panic can shatter decades of disciplined planning. The structural rule of index investing is to stay the course. When your portfolio is identical to the market itself, you cannot underperform it. This entire hands-off setup is engineered to serve as a psychological safeguard, protecting your wealth from your own worst emotional impulses when the market turns volatile. While the monetary payout sits decades in the future, The primary lifestyle benefit of this passive strategy happens immediately. While active traders spend hours analyzing charts and stressing over daily price fluctuations, the passive investor buys back decades of free time. The three-fund portfolio delivers the millions required for retirement while simultaneously granting the permanent freedom to never have to worry about the stock market again.